First quarter earnings season entering full swing, less than 2 weeks. Let's hear what one market expert had to say about where Wall Street analysts stand heading into the season here.
I think analysts are still in la-la land, Jared. They're expecting earnings to grow low single digits this year. There's a lot of dispersions across sectors, but I think that's wrong. I expect earnings to drop 15 to 20% from where we stand today. It seems like a big number, but it's just consistent with an average recession.
You can read more about the upcoming earnings season in today's morning brief, written by Jared Blickery, the man to my right. It's up now right on the Yahoo Finance homepage. All right, Jared, walk us through this. I mean, we were both listening to those comments
24
yesterday.
hours ago, this was all breaking down. So we had Alfonso Peccatiello as well as Matt Maley over on it at our studios yesterday. And one of the things that we're talking about as a predecessor to recession is earnings, re-rating. Basically, you have the S&P 500. Earnings are expected to be $218, $220 per share if you were to average the entire basket and weight it according to market cap, all that good stuff. And you can see plotted over time there. This goes back, 5 years or so, might be off. But that blue line is earnings estimates for the S&P 500. That's on the left scale. On the right scale, you have the S&P 500 itself. What happens usually is they drift down those earnings estimates as we head into earnings season. That's what's happened here. But we really haven't had a major revision cycle lower in some time. And that's the thinking, is that it's probably going to come with respect to some of the guidance that's announced this season. So if that happens, that's just one more checkbox on the, the checklist for recession. And kind of knocking at our doorstep right now. Now, Alfonso is saying that he's expecting that recession to come as early as June. That's about midsummer, and that comes a lot earlier than other people who are saying even a hard landing probably not going to come before the end of the year. So just to say there are differing opinions about this, and I guess there is still a possibility of no landing, of recession years in the future, but that seems way off base, or at least not off base, but I would say the probability is quite a bit lower since we've had that banking panic in the month of March. All right, let's continue this conversation ahead of earnings season next with our guest, Quincy Krosby, LPL Financial Chief Equity Strategist. Quincy, great to have you here. We've been talking about the data that we've been getting recently, and one of the things I noticed over the last couple of days, bad news kind of means bad news in the market. In other words, these reports are being released, they're not living up to expectations, and we're seeing stocks or stock futures drop on the announcement. That tells me maybe traders aren't thinking that the Fed is going to pivot that hard or that fast, or it's not going to be soon enough. Just wondering what your thoughts are.
Well, there's another worry in the market, and that is that perhaps we're moving into a stagflationary environment. And this is something that the Fed and no central bank wants, which means that they will keep at it until they manage to get inflation down as close to, the 2%. They're not going to get to 2% right away unless there is a deep recession, and that'll do the work for it. But they do not want any hint of stagflation. You notice that he always talks about no pause, He's talking about the 1970s where we had stagflation, and when Paul Volcker took over, he had to go at it unbelievably, bringing the rate hikes up dramatically. He doesn't want to go in that direction. So the point is that the Fed will probably keep going as long as they can unless something else breaks. And when I mean break, I don't mean the crisis, quote unquote, that we had in the banking sector, but something much bigger that has a tremendous contagion in other classes. So I think they're going to have to keep going.
Even as we kind of strike the opening bell here in the U.S., a lot of investors are still trying to think about, all right, we're not trying to fight the Fed, but how can we best anticipate them and make decisive portfolio decisions with that intention? What would you recommend?
Well, you're in a position right now where you're starting to see, the value defensive names starting to pop up again, following a period in which, every rally we had was oriented. The orientation was to cyclical, to recovery, semiconductors, consumer discretionary, all the things that you want to see in a rally. Now what you're seeing is the market suddenly resurrecting utilities, resurrecting healthcare, consumer staples, We thought we had buried that and that we were just marching towards a recovery into a more, bullish environment. The market, and we always have to say, we trade and invest in the market we have, not the one we want. We need to see if this movement into those defensive names is viable. Is it just a couple of trading sessions? That's not what we want. And so sometimes it just pays to, pull back, watch what's happening, and make a decision. We're going to be helped by the labor market report on Friday. That's going to help us in assessing whether or not the labor market is dramatically pulling back, because a real recession in our country, it starts with the labor market. And when that starts hurting, consumer spending follows, personal income follows, and that usually brings us to a full-fledged recession. We're not there yet. And so we want to be constructively optimistic, but not naive. Right now, we would be looking at, again, short duration treasuries for the portfolio. That is still attractive. It's still secure, and we would place money there. We also like the preferred stocks. They're offering, value. They're offering a return. We wouldn't be shooting out the lights with them because that requires much more risk taking. But even with some of the large banks, the large money center banks, the prefers are actually quite attractive. So again, there comes a point in a market where, patience helps, because we are transitioning to a slowdown. The question is it leading us to a recession? By the way, the yield curve is showing us that the 3-month and 10-year has deepened with each and every negative. And as you said, the market treating it as bad news is bad news. That's indicating a recession is coming sooner than we are projecting.
So if we take stock of the first quarter performance, where we saw the NASDAQ up something like 16, 17%, while the Dow was languishing, did the market simply get that wrong? Was it an artifact of an unusual environment? And should we not be extrapolating that kind of outperformance by tech and growth going forward, given what we know now?
Well, you can't negate the price action in the first quarter. It was tremendous. It's just that suddenly you've got an added brick, shall I say, to the wall of worry. And that is, you're concerned about the loan environment, banking environment in terms of credit availability. That hurts. If we, in fact, see loan origination slowing dramatically, and individuals and small business owners can't get access to attractive loans, that is going to hurt the economy much more. We didn't have that in most of the first quarter. And it was also interesting how well the market was able to navigate around the quote unquote crisis in the banking system. But you still also have worries, and you don't want to overplay it. There are always worries, but the very same conditions that fed Silicon Valley Bank, Signature Bank, and so on, they're still there, and they fed, with easy money, low rates, practically zero rates, commercial real estate, private equity, venture capital. So it is most likely, over the next number of months, we're going to see pockets of vulnerability there too. You want it to play out, because the more it plays out, the more it's not a shock to the market. But that's why, as you pointed out, the earnings season and guidance is going to be extremely important to help define where we are heading and what companies are saying, particularly about their operating margins. That's going to be key.
We're going to get that commentary in scores over the next several weeks here. LPL Financial Chief Equity Strategist Quincy Krosby. Quincy, thanks for the time this morning.